Sometimes investing is about trade-offs. There are endless investments in the world, and we must sift through all of that to create our optimal portfolios. On this channel, we focus on stocks. So fortunately, that narrows the investable universe considerably. It is my opinion that stocks are the premier asset class for building wealth. And whittling down our focus further, it is buying high quality stocks and simply holding them that supercharges wealth. But even within this focus, there are copious amounts of ideas on how to best buy and hold. This video aims to address the most classic of these debates. Do we buy growth stocks or dividend stocks? Welcome to the Quality Investor. One can construct their portfolio in a myriad of ways. And one of the most popular ways is to construct a portfolio of dividend payers and then reap the rewards of the most passive type of income there is, dividend income. Now, in this video, I am not trying to settle any debates between growth and dividend investing. Far from it, actually. I believe there is a place for both, and the style of investing one chooses must directly reflect a combination of their current needs and future goals. The easiest example of this is a retiree that has built a portfolio of high-paying dividend stocks that pays enough in passive income to support their lifestyle. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Rather, this video is about discernment. It is about sifting through the thousands of dividend stocks to create a dividend portfolio that can achieve your goals in perpetuity. I think a sweet spot exists where we as investors can enjoy both high growth and high dividends. It just takes knowing what traits to spot when screening for dividend stocks. And once you know these traits, you can build the type of dividend portfolio that's right for you. I will briefly describe those traits and then show some examples of how to screen for them. I will also show you the dividend stocks that I currently own and how they align with the traits I'm describing. And finally, I'll name off a few dividend stocks that are popular in the dividend social media world that you should avoid, but also name a few that you can consider right now for your own dividend journey. When screening for dividend stocks, the first couple of traits you must know are dividend yield and dividend growth rate. These are the most common ones and also quite important. Another trait that is important is payout ratio. And the payout ratio I'm talking about is free cash flow payout ratio. I never look at the more common earnings payout ratio because dividends are actually paid out of free cash flow and not earnings. And a final trait I want to describe is the trend of the free cash flow payout ratio. I'll elaborate on that more in a second. So dividend yield is fundamental to understanding dividends. It is calculated as dividend per share divided by share price. It is akin to the interest yield on a bond. So getting a $5 dividend on a $100 stock, that's a 5% dividend yield. A $10 dividend on a $100 stock is a 10% dividend yield. So clearly, a higher yield is better, right? You get a higher return effectively for paying the same share price. Well, yes and no. A high yield can be a double-edged sword. Some high-yielding dividend stocks are that way because the underlying business has a policy of paying out as much free cash flow as possible in dividends. Many REITs or real estate investment trusts are like this. But some pay high yields because the share price is falling. Remember the $5 5% yield example? If that stock drops to $80 per share, your yield becomes 6.25%, a bit higher. But you just suffered a capital loss of 20%. And capital loss, that hurts way more than the good feeling of a small bump in yield. So it is good to compare yield against share price return, as you'll see in a second. Then there is the dividend growth rate. A good rule of thumb here is anything above 5% annual growth is good, and above 10% annual growth is great. But below 5% growth, That is a danger zone in my view because you're now running the risk of dividend growth losing to inflation. And this is a poor situation to be in if you rely on dividends for your main source of income. Effectively, dividends are your paycheck and you want your pay raises to exceed inflation. I'll show you what I mean when we get to the screener. And finally, there is free cash flow payout ratio. Now, this is calculated as dividends per share divided by free cash flow per share. It measures a business's ability to fund its dividend payouts to investors. A higher ratio means more free cash flow is going to pay out the dividend, and that means less free cash flow to allocate back to the business. As always, this could be good or bad depending on the business's policy and or the current trajectory of the business. That's why the last trait I mentioned is important. The trend of free cash flow payout ratio over time. A free cash flow payout ratio trending up can signal that a business is slowly becoming less profitable over time. Not good if you're counting on continual dividend raises. So let's turn to the screener to see how each of these traits all relate to one another so you can better visualize how to find quality dividend investments. So here we have a list of all the stocks I'm looking at. I'm looking at all the industries except for banks and insurance. Their free cash flow metrics don't really lend themselves to the tools I have here. Plus, I generally don't invest in banks or insurance, so I don't have them included here. And while REITs don't use free cash flow as the metric for where their dividends are paid out of, I do have them included here, but they are highlighted here in gray. I included REITs because they're generally pretty high yielding stocks. I'm also only looking at the S&P 500 businesses. I mentioned before that there's a sweet spot to growth and dividends, and I genuinely believe that that sweet spot will most likely be found within the top 500 businesses in the world. So what are we looking at here? Well, I have the 5-year share price CAGR for each business, how many consecutive years of dividend payments they've made, and then how many consecutive years of growth they've had in their dividend. It only goes up to 23 or 24 years for the longer term dividend payers because that's how many years of data I have in my database. Of course, a lot of these businesses have much longer track records than just 24 years. And I'm also only including dividend stocks that have paid out a dividend for at least 5 years. I have what their current dividend is, their current yield, and this is sorted by yield. I have their 1, 3, 5, and 10-year compound annual growth rate for the dividend, the free cash flow payout ratio, as well as the 10-year free cash flow payout ratio CAGR, or how much this percentage has grown over the last 10 years. So right away, we're looking at the top dividend yielders on this list. And there's some pretty popular ones with the dividend crowd here. Let's look at Verizon. So you notice with Verizon that this 10-year CAGR is red. They've only grown that dividend by 2.2% annually over the last 10 years, meaning it's less than that inflation threshold I mentioned earlier. So any stock on here that has a 10-year compound annual growth rate less than 4%, I highlighted it red because these businesses are not growing their dividend faster than inflation. And you can see that down here. A few things to note right away. So Verizon is a high yielder, 6.8%. And at first blush, that might seem like it's great. But you can see that yield has gone up pretty consistently now over time. And we also see right here that 5-year share price, that's fallen 8% annually. So their yield is going up because their share price is falling. And then you also see down here the dividend in blue, it's not growing very much. And you can see that in the year-over-year dividend growth chart down here. It's consistently growing less every single year. And a big reason for that is because their free cash flow is not growing. So you can see that free cash flow has not been growing. That means that their free cash flow payout percentage is consistently high. It's an average of 91.3%, but that's because there's some outliers right here. But while Verizon seems to have a good dividend yield at first blush, you can see right away, it's not a very attractive dividend investment just because they're not growing their free cash flow, their share price is falling, so it's questionable how long they can keep up these consistently high dividend payments. Another business I want to look at is Pepsi. Pepsi is another business very popular with the dividend crowd, and it does have better metrics than Verizon for sure. Right away, we see that 10-year compound annual growth rate for their dividend is at 7.7%. Not bad, not great, but it's above that inflation threshold. But we can see a few other things that might be concerning with Pepsi. First of all, that free cash flow payout ratio, its average over the last 10 years is 82.6%. Not only that free cash flow payout ratio average has grown 7.3% per year. And you can see that down here. That free cash flow payout 10 years ago was at 50.6%. Today, they're actually paying out more in dividends than they are in free cash flow. Again, this is another flag to look at if you're concerned about the ability of a business to pay their dividends going forward. Yes, Pepsi does raise their dividend very consistently at about 7 to 8% per year, but how much longer can they keep that up when their free cash flow is not growing as fast as their dividend? In fact, their free cash flow, you can see in yellow here, has declined a little bit in the early 2020s and has been pretty stagnant since. And because their dividend is rising much faster than the share price, that has caused their yield to increase. So again, Pepsi would not be a stock that I'd want to consider right away. But let's look at a stock that has a high yield and has grown their dividend by over 10% a year for the last 10 years. Hormel Foods. I believe Hormel is a dividend aristocrat. Correct me if I'm wrong, please, in the comments. But we can see a few things. Yeah, a 4.9% yield, not bad. However, that share price has fallen by 5.7% per year over the last 5 years, causing that yield to go up dramatically. Additionally, you can see that dividend growth rate has slowed down considerably in the last 10 years, now just 2.7% in the most recent fiscal year. Also, that free cash flow payout average over the last 10 years at 58%, but it's been creeping up 5% annually. You can see down here, it has definitely been increasing over the last 10 years. So that dividend growth rate has had to slow down in order to keep it under what their free cash flow per share is. So either we're going to see continued slower growth of that dividend, and possibly in the next few years, depending on how things go, of course, they might have a dividend cut. And speaking of dividend cuts, let's look at 3M. Now, 3M is a former dividend aristocrat. They were forced to cut their dividend in 2024, and you can see all the signs of that cut were there. Free cash flow had become stagnant. You can see here the free cash flow payout ratio is steadily rising over time. That dividend yield was going up because you see that share price here. It's fallen 6% annually over the last 5 years. So that dividend yield was going up. They were slowing down dramatically their dividend growth over time. And ultimately that all led to their dividend cut in fiscal year of 2024. So that means that their dividend 10-year CAGR, way less than inflation, just 0.5%. And it's negative now for the 1, 3, and 5-year metrics just because of that dividend cut. So you have to pay attention to these things when you're looking at some of the higher yielding stocks. And those are some examples of stocks to avoid that are pretty popular with the dividend crowd, but I think for the wrong reasons. Before I show you some great dividend stocks that you can invest in right now, let's take a look at some of the dividend stocks that I'm currently invested in. We have MSCI, Visa, Microsoft, Applied Materials, Intuit, Costco, and MasterCard. I also have a lot of Google stock, but they just started their dividend, so they don't meet that 5-year threshold for this screener. But let's look at some of these traits that I've been talking about. Now, the first thing to understand is none of these actually have a very high yield. The highest yielder is MSCI at 1.3%, but the median yield of all of these businesses is actually 0.7%. What they do have, though, is very high growth rates. You can see all of them exceed 10% for their 10-year compounded annual dividend growth rates. And not only that, they exceed 10% on their 1, 3, and 5-year CAGRs here. The median growth rate on a 1-year basis is 15.6%, and the median on a 10-year basis at 15.3%. So these are consistent dividend growers. Another important trait here is they all have very low free cash flow payout ratios. All of them are below 40%. Now, I mentioned that sweet spot. I believe that sweet spot for a free cash flow payout ratio is between 10 to 40%. Within there, that's where you're going to find your best dividend deals. You're going to get a combination of high dividend growth, so those high annual raises, but also high capital growth. So you're going to have a high return on your stocks. Let's look at the 5-year share price CAGR for these stocks. The median, nearly 20%. and all of them have grown at least 10% annually over the last 5 years. And of course, the trend of that payout ratio as well. Now, MSCI, this has grown a little bit at 16% annually, but I do think this is more a function of how fast they've grown their dividend because they just started paying their dividend 11 years ago, and they grew it very fast initially, but it has slowed down to a more reasonable 16% annually. And you can see that that free cash flow payout has leveled off between 36 to 37%. But Microsoft is an example of a dividend payer that's very consistent, 10%, 10.5% annual raises in their dividend, but their free cash flow is growing like crazy. So you can see that trend downwards in their free cash flow payout ratio, very consistent year-over-year dividend growth down here. And of course, that yield has fallen like a rock because their share price has grown so much. So with these businesses, you're getting the best of both worlds, high dividend growth and high stock price growth. So if you're looking to start a dividend portfolio or you're looking for some ideas of good high paying dividend stocks to add to your portfolio that will ensure high dividend growth going forward, but also high capital appreciation, I think this is a pretty decent list to start. All of these businesses have a combination of historical share price appreciation plus historically high dividend raises. They also have free cash flow payout that's within 10 to 40%. So you're in that sweet spot right there. So let's look at a few examples. Williams-Sonoma. Williams-Sonoma has seen some very nice free cash flow share growth lately. This is a stock that has been on my watch list for a while. I considered adding it to my portfolio a few months ago, but I kind of missed out. They had a good earnings report. Their stock shot up after that, and it became a little bit too expensive for me. You can see they had some nice 5-year share price appreciation here, 1.5% dividend yield. Their dividend growth has been growing over the last few years, as has their free cash flow, and that payout ratio has been going down. Moody's, another very high quality business, another business I would love to add to my portfolio, has very solid share price appreciation. Now their yield is less than 0.8%, but they do grow their dividend consistently at over 10% per year. Their free cash flow payout is very steady. It averaged at 28.7% over the last 10 years. And you can see here that they're going to continue to grow that free cash flow and steadily raise that dividend. Two other stocks that I like a lot, we have Lam Research, another stock I wish I invested in earlier this year, but I missed out on that. They are a semiconductor equipment manufacturing firm. Everything that you want to see here is very solid, consistently low free cash flow payout ratio, free cash flow growing much faster than their dividend. The yields actually have been fairly steady, and they have a solid history of growing that dividend by over 15% per year. And another really great business is KLAC, another semiconductor manufacturing business. Again, everything that you want to see. Free cash flow is growing faster than their dividend, meaning their free cash flow payout is going down consistently. Their dividend growth is actually trending up over the last 10 years. It's at 12.9% on a compound annual basis, 10 years, but at 19.5% their last dividend raise. And that yield has been going down pretty consistently, but that's because their share price has been appreciating very nicely. So these are some traits to keep an eye on if you're looking to build a solid dividend portfolio that's going to give you consistently high dividend increases and share price growth at the same time. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.